Hello, I'm Sherry Penner, Deloitte Private's tax leader for Canada. I am pleased to share with you the third in our series of videos addressing the federal government's proposals on tax planning using private corporations. The term income sprinkling generally refers to the distribution of corporate income to a group of individuals, usually family, to reduce overall personal taxes of the group. This is typically done through a payment of salary or dividends, either directly or through a trust. Existing tax legislation already includes an extensive series of provisions to ensure that certain types of payments are reasonable, that income cannot be sprinkled in certain situations, and that there is no benefit of shifting income to minor children. The proposals released on July 18th extend some of these rules and introduce others that could significantly impact the way private company shareholders and their families are compensated. First, the tax on sprinkled or split income, often referred to as kiddie tax, will be extended to include individuals of any age, not just minor children. The broader application of these proposals, which have the effect of taxing split income at the highest marginal tax rates, would be achieved by applying several measures to any payments made. Of those measures, the proposed reasonableness test appears to have the broadest application. This test would look to three factors to determine if income should be subject to the higher tax on split income. These factors include the extent of labor contributions made to the corporation, capital contributions made, and previous returns or remuneration that the individual may have received. The new provisions are more restrictive for individuals who are between 18 and 24 years old, making it more likely for tax on split income to be paid by younger individuals. If an amount received is viewed as reasonable under these criteria, then the income should not be subject to tax at top marginal rates. A second proposal aimed at income sprinkling involves restricting access to the lifetime capital gains exemption available on the disposition of qualified small business corporation shares. Gains that would be ineligible under the new rule includes gains that accrue to an individual before the age of 18 and gains that accrue during the period when a trust holds the shares. These proposals could have a significant impact on existing private business structures, particularly when a trust holds shares, and could notably increase the total tax obligation facing entrepreneurial families. Since these rules are proposed to come into effect starting on January 1st, 2018, opportunities remain available for the rest of the year to make payments and realize gains under the existing rules. In addition, a one-time opportunity to make an election to crystallize an eligible capital gain and use the exemption in 2018 may be available. This election is part of the proposals, so planning should be considered to maximize the benefit of using this election before it expires. I hope you found this summary valuable in understanding the proposed tax changes related to income sprinkling, and I encourage you to talk to your Deloitte tax advisor about the changes before the end of this year. We look forward to sharing additional insights with you in the coming weeks and remain ready and able to help you navigate these changes.